Now it's time for Charting Futures. Here's Abigail Doolittle. And Abigail, we're looking at a second down day in a row for stocks, but you're taking a longer view.
Well, you're right on both points, Romaine. We are down for a second day in a row, although the decline is less than 1%. And for the S&P 500, that comes within huge gains on the year. So let's put this into perspective. Take a look at those E-mini futures there. You see up nearly 19% on the year, on pace for the best year since 2017. And if they gain another percent, they'll actually be on pace for the best year since 2013. The NASDAQ 100 futures up even more, outperforming, up 23%. Some underperformance for the Russell 2000 futures, but that underperformance still means up 16% on the year. Now, one futures market that opened more recently in May that I'd like to highlight by going into the Bloomberg, the micro E-minis. Take a look at this, going back to the beginning of May. In white, we're looking at the micro E-minis. In blue, we're looking at the S&P 500 E-minis. So you can see how closely those micro E-minis are really tracking the S&P 500 E-minis, both above the 10-day moving average. You can see a nice uptrend here, although it does appear that we could see a little bit of underperformance down to that 10-day moving average, maybe below, based on the RSI momentum indicator coming off the top. But nonetheless, again, we're looking at a bullish year. To talk more about what could be ahead for those micro E-minis and the S&P 500 E-minis, I'd like to bring in Jay Pestrichelli of Zega Financial. And what do you think of those micro E-minis, Jay?
You know, Abigail, I think they're a great product for the individual retail investor, right? Gets you into the futures market with not a lot of capital up front, doesn't put you too much notionally exposed. I think they're great for the individual.
Okay.
Yeah, it's a nice product, and they track pretty well to what the larger minis do.
Yeah, they certainly do. And you're bullish on the larger minis. Let's take a look at your weekly chart on the larger minis, suggesting that there could be some nice upside here for equity investors.
Yeah, exactly. So for us, we're long-term hedgers. We like to invest. We certainly like to hedge when volatility is low. It's a lot more effective to put on positions that will grow as the market moves higher. And so what we've charted here, there's a couple lines here that we're looking at where we are putting in a floor in our portfolio, but still giving us upside exposure if the market appreciates.
Got it. So can you explain those levels just a little bit more before we take a look at how you play it on the option side?
Absolutely. Yeah. So we are actually long puts at the 2,800 on the E-mini. So that kind of puts a floor in the portfolio.
Okay.
Limits the amount that the market, regardless how far it drops, limits the amount that the position could lose.
Okay.
And then we actually end up being bullish, where our break even just with the futures option positions by themselves is above about 30.90. So that's about a 3.5% appreciation. But that's the cost of being hedged. Which is actually, you know, our intention of limiting the downside but creating upside exposure for us.
And it's pretty interesting that where you have that limiting downside level, basically a stop is on that 40-week moving average or the 200-day moving average. And now let's take a look at the bullets on this, because that green line basically above that means that you're going to gain, but I'd like you to talk a little bit more about these details. Maximum gain, unlimited.
Yeah, sure, absolutely. Yeah, so the details of the trade are here. We've got a long call and a short put. That is a synthetic long stock position, right? It means we're replicating being long the market, but it makes very good use of our exposure, meaning the cash that we have to lay out for it. And then this long put at 2,800 puts a floor in the portfolio. And so we really, our estimated loss is at, only like a 4.5%. And then this 3.7% appreciation is where we start to make money. Now, the great thing about this trade versus, say, just going out and buying stock is we use very little capital to do this. And so if you could then take that freed up capital, put it into really a mildly risky, not even that risky bond portfolio, you can almost fully pay for the cost of being hedged. So you have this upside exposure, limited downside, but it doesn't cost you anything to stay long the market.